All right, welcome to our video on capital budgeting. So I wanted to build an example today, and I wanted to go over a couple of ideas using time value of money that we've talked about so far. So we've talked about time value of money, and we've talked about this concept of present value. So we know some value might exist out in the future. We can predict the time, how far out we go, and we can predict or set a rate that we're required to earn. And so that is the basics you need for what we call a capital budgeting decision. So in my example, I have got an investment. I'm looking at buying a set of 90 bred heifers, paying $95,000 to get these heifers bought. I'm going to pay that in cash for my example here. Now I'm looking at what they will bring me back over 8 years, and so the required risk that I've got is a 9% return, meaning that I feel like I need to gain 9% on my money to make this worthwhile. So this is the classic example of what we call a capital budgeting decision. This could be used in lots of ways. It gets used all the time in things like developing, let's say, grain storage for grain bins and what that might save. Or if we're going to rent these out, it may be what we earn. So we're looking for some kind of a cash flow. Negative cash flows mean we lose money. Positive cash flows mean we are bringing extra money in. And so you've already looked at cash flow budgets. So we've already got that as just a standard idea of how we might get here. But how can we use this information? So that's what we're looking today at. So there's my variables. Here's what it cost me. There's the years I think I'm going to have to wait. And then there's the required rate of return I have. So what we want to do is set up what we call a capital budgeting example. So I'm going to start off with time. Time will start off at time value 0 and will run out to my future date. Now I'm looking at 9 years out, meaning that I'm going to sell these calves in that after that 8th production year. So I ran out to 9 years. Each year there is a net cash flow that I've just given you, and that's going to be listed here. So these heifers are going to bring me at first about $200 a piece in profit off the after the cost, and then I wean a calf. And then every year there it's going to change a little bit. And then at some point these heifers are going to start to maybe not all produce the calf that I need. Maybe I'm going to end up with less productivity or less weaning weight. And so I kind of have these starting to decline. And then in this last year, we are going to not get as many, and we're going to resell the whole group. And so that's the cash flows that I've listed here. They could be any really numbers, but hopefully the concept makes sense. So I've given you these numbers so that we can focus on what we call net cash. Now, net cash is going to start off by looking at that it looks like we paid out $95,000. So in time value 0, usually put your capital investment as a negative because it's not a positive cash flow, it's an outflow. So I got negative $95,000. And then I've already calculated these values for you, so I just brought them over just by using an equal sign to bring that over. And then in the last period, we actually get a little income from the heifers, plus we resell the whole pen for $35,000, and so there is our cash flow for that year. All right, so there is the table. That's what we need. We need this kind of a table. We've got it set up. The first thing I'm going to show you is what we call, and I've got present value there, and I really am trying to get to something called net present value. So net present value is just a net of all the present values across time, considering we have one of these up front is negative. Now, in some businesses, you might start off with a negative net cash flow right up front for the money you have to pay. If that's too much to pay, you can actually factor borrowing into here, and you can insert a couple of columns, and you can end up factoring in how it looks like with a loan. But we won't look at that now. I'm going to pay $95,000 up front. All of these, again, are the positive cash flows back. So net present value is taking the cost up front and then comparing it to the positive present values over time, adding all that up, and that is called NPV. Now, your calculators do this a little bit differently, but Excel handles it this way, and so I'm going to show you how that works. So what we're going to do is calculate a bunch of present values, add them together, and that's what makes this called net present value. All right, let's start with the first one. What's the present value of money you've got to pay out today? Well, it's the same amount. There's no time value of money decision. So I've already got a formula adding this up. So right now by itself, $95,000 looks like a bad idea. However, you do get $18,000 back the first year. The trouble is you've got to wait a year to get it. So what we're going to do is go to our little formula bar here, and we're going to calculate or find present value as a term. There it is. Double click on it. What it needs is rate. Well, there's my rate. What it needs is time. Well, I'm going to use my time periods over here because as I copy down, they'll keep working. And then I need a future value. And that future value, I'm going to put a negative in front of because it's going to discount it back to get a present value. And I don't want that to be negative too. So I'll put a negative in front of that 18,000 because I've got to wait 1 year to get it. So if you hit enter, then that is worth really $16,000 to me today in present value terms. All right, now I've written that formula once. Let me double click and check it out. That rate right there needs to stay D6. It doesn't need to move. A10 needs to come 2 years, 3 years, and such, and the cash flows need to also change. So I've got what I need. I can just simply copy paste all the way down, and it looks like that all of these years the earnings are, of course, jumping down to year 7. That's great, 17,000. That's only worth 9,300 today. And so that's the idea of present value. Well, when you add them all up and compare them to what the cost is up front, that is called net present value. And since that is a positive $35,000, that means that I am earning 9% on my money, plus I'm able to earn an additional $35,000 above that 9%. So that's actually the rate that I require, and I'm getting more than that. That's $35,000 extra after the 9%. So I'm really earning quite a bit more. So that's the idea of net present value. It's trying to see, does your investment have enough money to pay back the required rate of return? Now, if I were to come in here and say, I actually think this is really risky, I want 15% return, then you can still see that is still a positive number. So it looks like that my required rate of return of 9% is paying me back that plus more. So you want this number to basically be a positive. What if this number is a negative? Well, that means that you are not earning your required rate of return, and if that's what you need, and these variables are right, then this would not be a good decision. So let's just say we were interested in saying, well, we want a 25% return. Well, then you would get a negative in that case, and you would say, well, if that's the risk this has, then that's not a good investment decision for me. Or these variables aren't correct. There's lots of ways you could change that. All right, so backing up to our original question, it looks like this is a good decision. All right, let's move over to something else. Sometimes in investment or capital budgeting decisions, payback period gets some play. Now, the idea about payback period is forget time value of money. How long does it take to get your money back? And some folks look at that as a way to calculate the investment value. Is it good or not? Well, let's calculate how that would work. All right, so in the first period of time, we are paying out $95,000, and I'm curious, how long does it take me to get that back? Well, in year 1, it looks like we get 18,000 back, so that brings me down to 77,000. So I could just keep running that down until we get here. And so you can see that, if I get rid of that, you can see that in year 4, we're getting back, and we have leftover to get back $8,500 more dollars. Well, in the next year, you've got 20,000 coming to you. So actually, you only need 8,500 of that 20,000 to get your money back. So what's the payback period in this investment idea? It's the full 4 years, and we need some of the 5th. So the payback period in years would be 4.43. I think that's right. 4.43. And so that is because I am in year 4 needing the money to move into year 5. That's correct. And that would be 4.43 years. And that would be your payback period. So for some folks, that is a way that they want to look at that investment decision. And so 4.43 years is the time it takes to get your money back. If you're looking at an alternative investment, now notice you're ignoring the required rate of return here. You're looking at just time, not rate. And so we calculate it that way. If you're looking at 2 investments and one of them can get you your money back, you think, in 4.43 years, then you got another one that's a little bit longer term, and but maybe it gets you your money back in 5 years, but it's a 20-year project. That may be more attractive. But if you got two projects that have the same kind of rate of return period of time, I should say period of time, then the one that gets you your money back faster may be more attractive to you as an investor. But payback period's got some negatives. It ignores the risk reward here. And so it's something that we would want to maybe use with caution. Net present value really is superior in terms of real capital budgeting. Well, what's another way that this capital budgeting is looked at? And it's called simple rate of return. And so it takes an average return across the years and then divides it by the cost and just gets what we call simple rate of return. All right, so let's look at what that would be. Average is going to be the average of money that I have coming back to me. They've already been calculated. So that's $22,000 across 9 years that I get my money back. All right, what's the cost? Well, the cost is going to be, I'm going to put a positive in front of that for now. I know it's a cost. It's $95,000 is what, need to get that positive. There it is. That's what that would cost me to get this done. So I simply just divide this by the rate. And so it says, wow, you're earning 23% on your money as an average return. So this still looks like a good decision. Again, comparing two different projects to each other. Some people do simple rate of return. What's the problem with simple rate of return? Well, it ignores the timing of the money. Because if you look at this average, it could be that you get all your money in the 9th year and none of it in the first part. You still could average 22,000, but time value of money is really, you're ignoring time value of money. You're also ignoring risk. So payback period focuses on time, does not focus on risk. Simple rate of return focuses on not time, nor does it focus on risk. So it's probably less useful. The most useful analysis for capital budgeting is really, at least the more straightforward approach, is called net present value. And that's how you perform it here. So what would be some of the questions below here? Well, all right, what is net present value? Net present value is $35,000. This last one here I haven't talked about, internal rate of return. What is this decision earning me? Well, I'm requiring it to earn 9 and it earns me more than that. But internally, what is this investment earning? And so you can calculate that as well. And so let's run over here to our formulas. IRR, that's my formula here I'm looking for, internal rate of return. And it tells me to plug in the returns from a series of cash flows. Well, they are going to start with my negative money up front, and then each year I get all of these dollars back. And so if I hit enter here, it's going to give me a rate of 17%. So I am requiring this thing to earn me only 9. It's actually earning me 17%. So, in this case, I knew it was earning me better than 9. I wasn't sure how much, but now I know how much it's earning me, and that's called internal rate of return. So when you're looking at capital budgeting decisions, time value of money factors, net present value, internal rate of return are really the superior approach. These other approaches fall short. They're simpler, but they do kind of miss some important parts, and so that's why we focus on net present value. So the answer down here, is this a good decision or not? Yes, it is a good decision. Based on the variables. Why? Because your net present value is, as we say it needs to be, positive. As far as the payback period, you're returning your money at 4.43, and then we could even look at simple rate of return at 23%. However, those are not really the factors. Now that we've got all this answered, what if some of these variables change? Like, for example, let's say the $35,000 is too aggressive. These cull cows are not going to be worth that much money based on the market today. So let's just say that they're worth $12,000. So I just took out 35 and put in 12. You can see it still is a positive 25,000 almost, still a 15% internal rate of return. What if you just said, you know what, all of those are worth nothing? That's really the best way to do this. This is the furthest year out, year 9 for us. you still not killing off this decision. The decision is still $19,000 to the positive. So you could come in here and say, you know what, we've overestimated all of this. Let's say that $18,000 is $200 a cow is the best that we are going to get back. And so we're going to stick with $18,000 each year. You can see I can change these and my numbers start changing. And so it allows us to come in here and say, you know what, that $200 a cow, and then we're going to start backing off to $15,000, and then we're going to back off to $15,000 again, and then we're going to continue down even to 8. You're still at a positive net present value. You're still earning 10%. You're required 9, so you're still in good shape here. Things like payback period have now changed because you can see we're not getting our money back. We're about to, though, in year 5. So we need most of year 5 to get this done. I mean, year 6, excuse me, to get this done. Really 5 and a very little bit of 6. That's what it would be. So your payback period gets pushed out. Your average rate of return has been dropping because of that. But however, remember, these two have lots of negatives. So continuing to focus on this one, this is the idea of capital budgeting, and net present value is the best way for you to approach these decisions. And that's how the formulas work. So hope this video helps. Now give it a try on yourself with the homework for the week. Thanks.